morning. Welcome to Thompson Hine's weekly coffee chat series. Today's topic is launching an ETF, the first 10 boxes to check. I'm Bibb Stretch. I'm a partner in the Washington, D.C. office of Thompson Hine. Today, I'm joined by Rich Keary. Rich is the principal and founder of Global ETF Advisors. He has a long history in ETFs. He, for example, was head of ETF listing at NASDAQ. He's been involved in ETFs since 2005. And, in total, he's been involved in 100 ETF launches. I practice, if you want to call it ETF law, I was actually at the SEC when the first ETF was launched. So I've followed its whole existence. And even though it's now been around for a while, it's still very hot. Still lots of ETFs being launched, lots of new entrants into the ETF business. And so today we're just going to outline kind of the best practices that businesses should consider when they're launching ETF. We're going to hit regulatory, financial, operational, distribution. But a quick housekeeping, if you have any questions or comments, we encourage you to use the Q&A box on your control panel. We'll try our best to address those comments, but probably more than likely we'll end up following up by email. So with that, let's get started. I'm going to turn it over to Rich, maybe to start with, like, who are the types of businesses and persons entering into the ETF business these days.
Yeah, great. And Bibb, thank you for having me. Thank you, Thompson Hine, for arranging all this, and thanks for all of you for joining us today on this topic. So we appreciate your interest. Yeah, it's interesting what we're seeing now. So I think this year we're just about, we have already broken records for ETF launches, and it's not from all your traditional ETF sponsors. A lot of new entrants, as Bibb mentioned, coming into the space. And where are they all coming from, right? So we have a series of groups of people that are investment strategists that are on their own now. They have an idea, they want to bring it out into an ETF wrapper, and they're looking for some way of bringing that to market. You have an existing advisor or RIA who's got SMAs and mutual funds, and now they want to add ETFs to their mix and take their strategy into an ETF wrapper. You have existing mutual fund complexes that have new strategies, and they want to launch them into a new ETF wrapper and take advantage of what's happening and getting into the ETF space. And then we're seeing even the bigger, larger mutual fund companies coming in and even looking to convert existing mutual funds into ETFs, and that's becoming a bigger and bigger thing in the marketplace today, is those conversions. So that's the general look of who's launching ETFs today.
With that, so let's just go through the kind of the 10 boxes you need to check when you're thinking about starting an ETF. And there's no special order, but generally you want to talk about your strategy and think about your strategy first. And that could, kill it right there if your strategy is not workable in an ETF. There's certainly legal restrictions that don't apply, for example, to a hedge fund or an SMA. Diversification, both under the 40 Act and under the tax code. Things like that generally mean you can't have a concentrated portfolio. Generally got to have 20 securities in there. And then the nature of your portfolio kicks off income, and to meet IRS income tests, you have to have good income, which means certain investments like crypto, physical assets won't generate that income. Liquidity is critical. It's big, obviously, in the legal world with the new liquidity rule, but it's also very important in the functioning of the ETF and the create redeem process. The harder it is for APs to assemble baskets in that process, the more likely you're going to have higher spreads in a lower quality ETF. So that's certainly a key point. I will say that none of these are deal killers. They're workarounds almost on the legal side and also on the operational side. But you definitely want to focus on strategy first.
Yeah, and I would just add one of the things you have to look at too is sort of the a market review of where your strategy fits on the shelf with other ETFs. If you're going to go head to head in the low cost, ETF wars with a basic beta strategy, you're going to have a challenge. You're just not going to be able to afford to launch that ETF. We'll get into that later around some of the costs. So you want to look at what specific intellectual property you have within your strategy, and can you charge a premium management fee because of your intellectual property? So it's something else to think about as well.
Great. So let's move on to legal structure. One of the unfortunate consequences is all the way up to launch, you're going to have a lawyer involved. Heavy role in just kind of pulling everything together from a legal side to launch it. And you have obviously a lot of external people involved beyond your lawyers. You're going to have a board. Yourself is going to be the advisor. Potentially, you could be a sponsor and outsource the advisor function. If you're the advisor, you may have a trading sub-advisor. For example, if it's going to be an index ETF, you may not be comfortable with trying to run a strategy that tracks an index. A whole host of service providers we'll talk about later. Compliance, CCO. More and more people are externalizing that just because it just continues to be a focus by the SEC and having that kind of expertise. You're also seeing more lately people externalizing the treasurer role as well. So that's kind of the structure, and one of the key decisions right at the beginning is what type of trust to use. And so I'll kick it back to you, Rich, on the white label versus standalone choice.
Yeah, that seems to be the two choices that you're going to have to decide which way you want to go. The white label businesses are thriving businesses. They're launching lots of product. It used to be sort of cost and ease to market was a big part of their value prop. But now with, like we mentioned, all these different types of people that are launching ETFs, a lot of them don't have the operational capacity. And they're using the white label firms to give them that operational capacity. And that's a big element of why you want to go white label. They'll take a lot of your headaches off your table. The standalone is for people who have an existing products, mostly mutual funds. You have an existing trust, so you can move your ETFs right into an existing trust. You already have operational capacity within the firm to be able to manage a new product. And then you have control over your board, you have control over your process, you have control over your vendors. And that's a big reason why people want to go standalone. So it seems to be less seasoned people on the white label, more seasoned on the standalone would be a basic way of breaking that down.
Yeah, and the thing I'll add too is it's not necessarily binary. So if you do go standalone, often one of those white label firms will be the same administrator TA as if you were standalone. And you can also partner up with existing trusts that may be using the same service providers. And so there's a lot of different approaches to this. And I think sometimes people kind of get fixated that it's binary, standalone versus white label. Certainly, one critical part before you even launch an ETF is having assets. So why don't you talk a little bit about seed capital, Rich?
Yeah, this is the sort of the ever evolving problem in the ETF space that never goes away. Where are you going to get seed capital from to launch your product? Yeah, there's a statutory seed capital that comes from your lead market maker, the $2.5 million, but that doesn't cut it anymore. The capital markets folks, both potential lead market makers, NAPs, they want to see a product come to market that's got significant assets behind it that they know can grow, they know can trade starting day one. They want to get out of their seed capital within a few days of launching the product. So the general standard is you're going to have 10 or 15 million minimum in seed capital coming from existing clients or existing partners in order to launch the product. And it's a challenge. And when you go out to talk to the APs and the lead market makers, you have to have a distribution plan formalized where they know how well you can sell this product. That's a big component of it. And I think, as Bib alluded to as well in the legal structures, one of the things we're seeing now too is that some folks who don't necessarily have the seed capital, they can find a seed capital partner and create a new corporate structure where that partner can provide the initial seed capital, that 10 or 15 million dollars, and then get a benefit of some sort of ownership stake in the trust. And I don't know, Bib, if you want to elaborate on that a little bit, but that's another way of getting to the seed capital issue.
Right. So, obviously, let's say you're the advisor slash sponsor, you have an LLC, you could set up a separate LLC to perform that function and invite external partners to be limited partners or limited members of that LLC. So they have a stake in it. And structure that so they guarantee a certain amount of investment. They guarantee to keep that investment, let's say it's 10 million over 10 years, and quid pro quo, they get either part of the flow of the advisory fee, or they get that ownership interest in the LLC. Lots of variety there. You got to be careful about the securities law. This is typically happening or is happening before you launch, and the prospectus is effective. And there also can be, you don't want to create a class of shareholders inadvertently because ETFs can only have one class of shareholders. So a few little things, but it is quite common. So let's switch, Rich, to kind of talking about the internal capabilities of a person or a company that wants to launch an ETF.
Right. So once you get through all these issues, right? So legal structure and your standalone trust or your white label trust, you have to look internal to say, okay, what capabilities do we have internally that will help manage an ETF program, and do we need to bring in outside people? As we alluded to before, a lot of it is the same vendors, right? It's your fund admin, your CCO, compliance side, your distributor. The one space that's really different if you're a mutual fund or SMA and going into the ETF space that you may not be familiar with, and that's the capital market side. Because now for the first time, you're going to have to deal with market makers, APs, spreads, all sorts of things around an ETF that's trading throughout the day, all day, every day, when the markets are open, and liquidity issues. So you're going to really have to have some sort of ETF expert on staff to help you navigate those issues and talk to your clients and talk them through all those issues. So when you're looking at your capabilities and where you're going to need to potentially add staff, a capital markets person is first and foremost. The other space you're going to really have to look at in today's world is on the marketing side. Your sales and distribution is incredibly important in launching an ETF. And getting into the digital advertising space and marketing space with the ETF world is really important. So you got to make sure your marketing team is up to speed on all those accesses and getting into those new clients that are ETF users.
And it's common sense, but I see it not happening all the time. It's really helpful to have one person that knows everything, kind of like the captain of a submarine. He's able to fix or know a little bit about every single thing on that vessel, and that's, I think, is really critical in the startup phase, because you're trying to pull together lots of different vendors. There's lots of emails flowing around. Even though he may not have the direct expertise and he has to bring in other people, it really makes it an easier process if there's one point person. And then that really carries over after launch. I think it's more challenging, at least I see with my clients, when it's chopped up and there really isn't that one person that has a grasp of everything that's going on. And as Rich says, this thing's live, all those ETFs are live right now. Anything can happen, which is another reason that there needs to be kind of a go-to person. When the call comes in from the exchange saying, we've stopped trading, you don't want everybody looking around and pointing at somebody else as dealing with that unfortunate situation, which hopefully won't happen. So we talked about vendors, but Rich, do you want to go into a little bit more detail on vendors?
Yeah, I think again, we go through the whole list, from legal to fund admin, all the people that you're gonna lean on, and again, going into new relationships, you're also gonna have to pick a stock exchange. You're gonna have a listing, so it's a whole new relationship that you're gonna have to have, and also a potential marketing partner with you too as well. So looking at the exchanges and all of their capabilities, you have the three major exchanges, the New York Stock Exchange, NASDAQ, and the CBOE. All three of them are fantastic. All three of them do a really good job of protecting your product while it's live on the marketplace, and building that relationship with them is critical in managing your ETF going forward, as well as pre-launch. So I think outside of your typical vendors that we mentioned earlier, that's an extra one that you're going to have to think about as well.
Yeah, and I know, in reality, it's always going to be a rush to get the ETF launched, but it's a great time to talk to all these vendors. Rich mentioned the three exchanges. Talk to all three. Talk to several law firms. Talk to, several white label providers. Pick their brains. It's ever since I've been around this industry, it's amazing how people like to help each other out. If you're at a conference, people always like to talk about themselves. So if you can really take advantage of picking everybody's brain and then cross-checking with what you've heard, from a similar vendor to see if it all adds up. But you can get a great education, critical education in this process.
Yeah, and I would add just a personal note. I think it's one of the things that's kept me in this industry for so long is all of those folks that are running all those different vendors, as much as they look like competitors, and they are to a great extent, there's a great amount of cooperation and collaboration in the industry, and you have to have a collaborative process in order to launch an ETF because you're managing so many different vendors, and there's different, they all have their own personal needs in terms of managing their own businesses, and they're also looking out for your own. So having that collaborative process is really a great thing to have internally. And the ETF industry as a whole is just a great place for that to happen. It's exciting.
Okay, let's talk a little bit about regulatory considerations. One of the key decisions that you'll have to make is whether your ETF is going to be transparent or non-transparent. What I mean by that is, up until recently, when an executive order was given allowing non-transparent, ETFs have to post their basket before trading every day. Thus, you expose your strategy to back testing. Not a big deal if you're an index ETF, is a big deal if you're actively managed. So, and another recent event, was Rule 6011, which allowed you to launch an ETF without an exemptive order, so that and the exchange just followed through with revised generic listing standards that pretty much say if you follow that rule, you can launch. So speed to market, simplifying this process of organizing is greatly enhanced if you have a transparent ETF. Nevertheless, you may not want to. You may want to take advantage of going to a vendor, and there's a handful that offer the capability of turning your ETF into a non-transparent ETF. That's going to involve, some extra time with licensing. It also, your vendors are all impacted by that. So especially your lead market maker. So it's going to lead to a bunch of conversations. It's still relatively new. There's still some kinks out there. So just factor in that it's going to take more time to get a non-transparent ETF, in my view, out the gate as compared to a transparent ETF. The other thing I'll just mention is, ESG. Everybody's slapping ESG, not everybody, but people are tempted to slap ESG on their name of their ETF, and mostly from a marketing point of view. Some, have sincere reasons, and they want to offer a product that meets certain standards. I will say, you may have read, that's under heavy SEC regulatory scrutiny. It's definitely allowed, but you're going to get lots of questions, and you're going to have to really defend what it means that your fund ETF is ESG compliant. So just a heads up on that. Let's switch. We got a couple more. Switch to cost and return feasibility, Rich.
Yeah. So now we've taken all these things that we just talked about, right, and we brought them into your internal conversations. You're like, okay, this makes sense. I think we can do this. What are we going to get out of this program? What's going to cost us, right? And as Bill alluded to, any project plan you start, it's gonna end up costing more and taking longer to execute than you originally thought. The basic price level for, and let's just call it an ETF trust, just for the trust itself, and managing all the vendors, assuming you have zero assets in your fund, that can run anywhere from about $275,000 to $325,000 a year to manage that. So then you have to take on, like, do I have to add additional staff? Am I doing a conversion of a mutual fund? What's the legal cost of doing the conversion, whether it's a mutual fund or an SMA? So there's all sorts of ancillary costs away from the trust that you have to look at as well. And then, of course, you have to go back, like we said in the very beginning, look at your strategy. What are the basis points the market can hold, where I can sell this product at the right price? And at that price, what's my break-even point? Is it 50 million in asset? Is it 100 million in asset? And can I get there just to break even on this thing? So those are parts of that, those costs and feasibility things that you have to look at in towards of moving forward. And again, like I said, if you have to add extra staff and then other things, there's additional costs on top of that, $275,000 to $325,000 that you have to think of as well. So that really starts to move the needle now of whether or not you're going to want to launch or not launch the product.
Yeah, and let's say you decide to launch, or you're still mulling it over. One of the questions I always hear, and Rich hears, and everybody's how fast can you launch? And what we're talking about now is kind of coming up with a realistic project plan. And first of all, we go back to the standalone versus the white label. Again, you got to really listen and ask lots of questions. Standalone, it's more involved because you're setting up a trust and bringing in trustees, etc. But on the regulatory side, it still takes 75 days for a white label for a fund to get launched. Obviously, there's legwork before that, and that's 2.5 months. I always get in conversations with the standalone, and immediately the client starts bargaining. I'll throw out 5 months, and they're like, "Can they say 4.5? Can we do it then?" So at the end of the day, it's quicker through a standalone, but there's a lot of stuff that has to be done on either side, and there's really not that, in my view, not that big of a difference to market between the two at the end of the day, whether it's a month or 6 weeks or so. One of our questions asked about how long would it take to do a non-transparent, and again, there's some extra steps, and part of that answer depends on really on your bandwidth. If you've got, 15, 20 things, they all can, in theory, be done simultaneously, but you can't do them simultaneously, or you don't have a staff, then, that's just adding another distraction, because there's still lots of still things that you need to work out with vendors and everybody else. So I mean, there's nothing magic about this, but I'm finding, that may take, you may want to build in an extra month or something if you're going to go that route. Again, it's just how much you can get organized and delegate out all these various tasks, because there's a lot of them.
Yeah, and I would just say, right, in the way we've gone through these in the past, right, the project plan is incredibly important because, like we said earlier, you have so many different partners that all has to be managed, and you have to have a really cohesive plan to execute to bring this to market. It's got to be very, very focused, and yeah, things can move in parallel tracks. But I think Bill will tell you more than anybody, at the end of the day, the thing that delays the launch more than anything else is the SEC. There's something in your strategy that they have questions about. There's something in your corporate structure they have questions about. And that just can delay as you're going back and forth answering all these questions to the SEC about your filing. So if there's going to be a delay to market, it's usually coming from the SEC.
Yeah, and it's an excellent point, because that's why it's so elastic, this timing. Not only is it a difficult strategy, but if you're going to add on non-transparent, if you're going to do a derivatives, the more you get away from a simple large cap equity fund, the longer it's probably going to take. At the end of the day, you want to get, number one, the product you want, and it's worth waiting for. And then number two, to understand these decisions are going to have long-term consequences. So you got to step outside of the present and project to how it's all being structured, who your partners are long-term. It's hard to do that because you're racing to get it to launch. But there are a lot of people that have regrets about certain decisions they made early on, and they live with it. But it's important sometimes to pad that launch timeline if you can with some extra time. Well, let's quickly end on the go and no go decision, Rich.
Yeah, so I think, like I said, we've had this whole decision tree we just went through, right? And you're finally like, okay, we're going to launch. You really have one last thing that you really have to kind of dig deep inside about whether or not you want to launch, right? And that's, can I sell this strategy? Who am I going to sell it to, right? And 10 years ago in the ETF world, it was, hey, just bring it to market and, it will, the assets will come. That's no longer the case. ETFs have to be sold. What's your distribution plan? Can you sell it? And we're seeing more and more in the industry now that these distribution channels that are I don't know how to say it properly, but they're really proprietary. To think that you can build a product and like take 10% of the assets away from Global X on a thematic or Invesco or BlackRock, that's just not going to happen. But if you're an established ROA and you have a track record of raising assets, look at that. Look at your channel, look at your clients, and say, can I get to that $50 or $100 million of break-even point through my current client list, and that's going to really be the final straw that's going to get you into the marketplace or not. That you can get to break even with your existing clients, because trying to expand your client base becomes a very big challenge in the distribution, and it takes time. We're usually talking about at least a 3-year run rate to get a return on that investment on your fund. So you're going to have enough cash flow to keep that ETF up and running for at least 3 years before you see a real return on it. And you have to have that financial wherewithal to be able to manage that.
Well, great. That concludes today's chat. If you missed a past coffee chat, we encourage you to view our Thompson Hines library recordings. Also, I want to thank you for attending the program. I really want to thank Rich for joining us, and have a great rest of the week. Thank you.